I'd like to introduce Shaun Roache, APAC Chief Economist at S&P Global Ratings. Today, Shaun will talk about how Asia Pacific goes back to work gradually. Shaun, over to you.
Good morning, good afternoon, and good evening, everybody. Thanks for joining us today. I'm going to talk about the Asia Pacific economy and the post-COVID recovery. I have 3 points for you today. The first is that jobs matter. That's really going to determine the shape of the recovery over the next 1 to 2 years. Secondly, China's recovery is underway, but it's not as strong as it looks. And thirdly, the U.S.-China relationship, our recommendation is buckle up. It's not going to get that much better anytime soon, but focus on the technology sector. But let's first talk about the recovery and think about how quickly Asia Pacific can get back to work. So on this slide, what we are showing is how different countries have grappled with COVID-19 since it broke out earlier this year. These charts show a measure by Oxford University which tries to give an indication of how tight social distancing policies have been since COVID-19 emerged. When you see a line that's close to 100, it means that policies are incredibly tight. When you see a line that's close to 0, it means that we're getting very close back to normal. And if you look at these two charts, one on the left-hand side for the country's developed markets and the one on the right-hand side for emerging markets, you can see clearly how governments responded to COVID-19 this year by tightening social distancing measures, implementing lockdowns in many cases that in some emerging markets got very tight indeed. But since then, since April and May, we've seen some degree of loosening in those restrictions as COVID-19 infection curves have peaked and in most cases, but not all cases, started to come down. Now, what do you take away from these charts? Well, first of all, that every country is different. Clearly, you can see the extent to which different countries have been doing different things to try and address COVID-19. But I think what we would take away from this chart is, in terms of lockdowns, the worst has passed. We do think for most countries that we're not going back to where we were in April, May, and that economic sudden stop that caused all of those big downgrades to people's growth forecasts for this year are behind us. But at the same time, if you look at these charts, we're some distance away from 0. Governments are still maintaining a reasonably tight policies on some of these social distancing behaviors, and that means that we're not going back to normal anytime soon, or at least not until a vaccine becomes widely available and is distributed across the world. But it's not just government policies, of course, that determine what the economy is going to look like over the next 1 to 2 quarters and going into 2021. Households and consumers themselves also change their behavior when it comes to COVID-19. And that can be shown by data that we get on a daily basis now from people simply using their cell phones. So you may be quite familiar with the data now that we get from Google Mobility. This shows how much people are moving around in their neighborhood. And these two charts show, again, for the region's developed markets and the emerging markets, how much people are moving around in 2 areas. First of all, what we would call discretionary retail. So we're not including grocery stores or pharmacies, because people have to go to the grocery store. We're talking about clothing shops or electrical shops, and also recreational areas. It could be parks or museums or galleries. These are trips that we would call discretionary trips. They are trips that people make if they want to get out of the home, if they feel comfortable about leaving the home, if they feel more confident that they're not going to get infected. And 0 on this chart means that we are at normal levels. When you're below 0, it shows how far we are away from a normal scenario with people staying at home and staying away from those public places. Again, it's a similar story as we saw in terms of social distancing measures. During April and May, people were staying home much more often than they were normally, and mobility collapsed in many cases. Mobility was particularly low in some of those emerging markets that implemented the tightest lockdowns that we saw anywhere in the world, including India and the Philippines. But what we've seen since then, since April and May, is that people are starting to move around a little bit more. The recovery has begun as COVID curves in general have flattened off in many cases, although we are of course seeing some second waves. We have started to see people moving around, and that's important for the economy. When people go to public spaces, they typically spend money on goods and services. They're visiting cafeterias, restaurants, other recreational areas, and that's going to help bring back some activity. But at the same time, what we would take away from these charts is we are still, in many cases, not back at zero. We're not back to normal. And the way to think about this is that we could be living in this 90% economy for some time, where we're getting closer to normal, but we're not quite back to normal yet. And that's going to affect some sectors more than others. And it's going to mean that the economy is not going to get back to a new normal, perhaps again, until this vaccine arrives, which we think at the moment is most likely around the middle of next year. This all, of course, is affecting growth and activity generally. So this chart here shows GDP growth across Asia Pacific over recent quarters. And what we've also shown is the 5-year average growth rate, just to give you a sense of how quickly these economies have been growing over recent years. That is the yellow line on these charts. And direct your attention to the dark blue line, that dark blue bar. That shows you the growth performance in Q2 when we think the hit from COVID-19 is going to be at its worst. And what you can see is a wide variety across the region. Some countries escaped relatively well, Korea and Taiwan, and that of course reflects the fact that COVID-19 in those countries was broadly contained. But at the same time, in those other countries where we saw very tight lockdowns, where we saw people stay at home much more often than they normally do, India and the Philippines, we saw GDP growth at close to -20%. But again, the good news here is that we think we're past the worst. We're not going to see numbers like this again in the coming quarters. But one thing I would say to people who are thinking about growth and how to think about the economy over the next 1 to 2 years, don't just look at growth. Look at the levels of activity. You're going to see some quite strange growth numbers in the next few quarters because we're coming off such a low base. So think about activity relative to normal levels, a bit like we showed with the mobility data earlier. And we'll show you a chart later that gives you a sense of what Asia is going to look like, we think, in this recovery compared to previous recoveries. So what should we expect during this recovery? Well, I think China provides some interesting lessons. Of course, China was first in and was first out. And this chart shows the contribution to real GDP growth in China by different industries. So if you look at this chart, the light blue line shows the contribution to overall GDP growth from the manufacturing sector. And before the crisis, this was running at about 1.5%. Then, of course, you see the crisis hit in the first quarter of this year. You see growth collapse, and you see the extent to which, in this case, manufacturing subtracted 3% from GDP. Now look at the far right-hand side of the chart. This is showing you what happened in Q2, and the lesson is instructive for Asia. Manufacturing bounced back fairly quickly. The resilience of supply chains in China has been remarkable, but the service sector, in this case, we're focusing on hospitality and retail. That's the pink line, hotels, restaurants, shopping malls, movie theaters. This is a sector that continues to struggle. In fact, it didn't grow in the second quarter, and it's going to continue to struggle for the rest of this year, we think, because of still some social distancing policies that are in place in China, but also the behavior of households. Maybe they will avoid public spaces where there are going to be lots of people gathering, and that's going to keep demand for some of these industries suppressed for quite some time. Again, until a vaccine emerges, we think at some point next year. So why is this important? Well, this we think is important for jobs. And let me just show you some data just to underline how important this lesson from China is for the way we think about jobs and the way we think about the recovery. This chart shows the distribution across different Asian economies of jobs by industry. So if you look at the left-hand side of this chart, the light and dark blue bars show the proportion of total employment in all of these economies that are in two sectors: retail, accommodation, and food services. So the hospitality sector. 20 to 25% of jobs across Asia Pacific are in these two sectors, and this is a sector that is going to recover only slowly over the next 12 to 18 months. In fact, more broadly for services, and of course remember, most services involve face-to-face activity, around 60 to 70% of total employment is in these industries. So while manufacturing has bounced back quickly, and China has shown that, we don't think that is going to bring back a large number of jobs in the short term. And that's going to be very important when we think about what that means for consumption and what it means for inflation. Just to underline that point a little bit more, this chart is similar to the one previously, but it shows the contribution from different industries to total employment growth in different economies over the last 20 years. When a bar is to the left, it means that employment in those industries shrank, got smaller. If a bar is to the right and is positive, it's showing that this industry created new jobs. And what you can see clearly from this chart is how much the service sector has generated jobs growth across the region, including in economies like China and Indonesia. In fact, in many cases, the service sector has accounted for about 90% of total jobs growth over the last 2 decades. So yes, manufacturing can come back, but that is not going to be enough to deliver a rapid improvement in the labor market. And we think that jobs are going to come back only slowly. But we shouldn't get too gloomy. As we suggested earlier, the recovery has begun, the worst has passed, and you can see that clearly in some of the labor market indicators. So these two charts show employment across different Asian economies since the beginning of last year. And they show a gentle upward sloping curve as these economies created more jobs. Then, of course, COVID struck. We saw massive job losses in some of these economies. But in some cases, we've seen those job losses stabilize and some jobs are beginning to return. That's particularly true in those economies that have managed to contain the virus. So we're thinking about economies like Korea and Taiwan. But even in Australia, which is still struggling with COVID-19 at the moment, we have started to see the employment market stabilize to some extent. But we shouldn't be too hopeful at the moment that this is going to give us a very rapid improvement and unemployment rates are going to be back to where they were in the next 1 to 2 quarters. In fact, we think that it may take until 2022 or 2023 for employment to get back to where it would have been in the absence of the virus. And that's even assuming that we get a vaccine next year. And one of the reasons for that is when you lose a job, it sometimes takes a longer time to find a new one. Perhaps your employer went bankrupt. Perhaps your employer decides that they don't need you anymore. Perhaps the employer decides to do something else and needs people with new skills. We often see this in these recessions. Jobs are easily lost and quite hard to regain. And that's going to be quite important when we think about how quickly consumption can come back, because clearly consumption is driven by wages and wages are driven by jobs. The other thing we think it will mean is low inflation. So employers are not going to have to give their workers wage rises to keep employees or to find new ones. There are going to be so many people looking for a job that it's going to be easy, we think, for firms that want to hire at current levels of wages. And when you think about selling prices of goods and services, but particularly services, wages are the most important component of that. So firms often have a small markup over the total cost of the goods or services they're producing, and that total cost is largely made up of wages in the modern economy. If wages remain quite low, then prices are going to remain quite low, and that's going to mean low inflation, and for financial markets that means low interest rates. It seems very unlikely that any central bank in the region would be contemplating raising interest rates at least over the next 12 to 18 months. In fact, we think interest rates are going to stay very low all the way through 2022. And that's probably also true in the United States and Europe as well. So this is going to remain a world in which interest rates remain pretty close to zero in the developed markets and at record lows across the emerging markets. What does this recovery look like when you stand back and think about it in the broader scheme of things? Again, earlier on I said, don't think so much in terms of growth, think in terms of levels, and that's what we do here on this chart. So the brown line on this chart shows our forecast for Asia Pacific, excluding China and India in this case, because we don't have very good quarterly data, which this chart is based on. And that's compared to the last 3 recessions across Asia Pacific. And some things immediately strike you about this chart. First of all, the brown line goes negative very quickly and is more negative than any recession that we've seen over the last 30 years. So the shock from COVID-19 was both rapid and larger than normal. At the same time, if you draw a line from what the pre-COVID trend looked like, you can see that we never get back to where we would have been in the absence of COVID. That's going to be an important part of this recovery, we think. We will recover back to pre-COVID levels of activity, but of course, Asia Pacific should be growing at about 5% year on year, and we've lost some of that growth forever. We're going to have some permanent damage to economies that will never be recovered. And that's going to be important when people think about revenues for companies or industries, wages for people that are working in various industries. There are going to be permanent economic losses. And we all need to think about what that means for financial markets, for credit, and for all the other things that matter when we look at overall economic activity. But broadly, when we put this together, we don't expect this to be another Asian financial crisis. That's the other thing that strikes you about this chart. The light blue line is the Asian financial crisis of the late 90s. And what you can see here is that the balance sheet damage during the Asian financial crisis was so large that it dragged on activity for a sustained period of time, and the permanent costs were massive, close to 10, 12% of GDP across the region. We think in this episode, we're going to see permanent damage close to 3%, which is broadly in line with what we saw during the global financial crisis. So it's bad, but it's not as bad as the Asian financial crisis in terms of the long run damage that this will cause. I'll come back to the global growth forecast later just to pull all this back together. But first, let's switch gears a little bit and look at China. What's happening in China? There's been a lot of optimism, I think, recently about the second quarter number of GDP, which suggested that China was growing again. We are a little bit cautious about that. And I think for now, we're not convinced that the recovery is self-sustaining. You can see that just looking at some of the most recent economic indicators. So here we have the most important monthly data that we track for China, things like fixed asset investment, industrial production, exports. And you can see, no doubt, a recovery. Things are getting better. In some cases, we're getting close to average growth levels, certainly for industrial production. And in some cases, we're doing better than we normally do. Look at the property market, which has done quite well so far this year. But there is one area that stands out as being exceptionally weak, given what's going on in the rest of the economy, and that is retail sales. Retail sales in July were still 1% below where they were this time last year, and that is 4 months after the peak in COVID infections. This is really important for China because the economy has become more consumer driven over time. And the consumer at the moment appears to have really slowed down their spending. And it's going to be difficult for China to engineer a self-sustaining recovery unless the consumer comes back and starts spending again. So what's going on with the consumer? If things are going so well with COVID-19, why have Chinese consumers scaled back some of their spending? The answer is they have suffered a very large income shock. This chart shows disposable household income growth in China over recent years. And we break it down in terms of wages and salaries, business income if they're self-employed, or transfers from the government, which might be pensions or unemployment insurance. And you can see that Chinese households had started to get used to income growth at about 8% per year, and it was fairly smooth. And that was fostering a rising middle class, it was boosting spending, it was boosting consumption and retail sales. And then COVID-19 hit. And Chinese households so far this year have seen their income growth go from 8% to less than 2%. And this is a very large change when you compare it to the stability of recent years. The other interesting thing about this chart is just look at the brown part of the bar. That is government transfers. Now, in other economies, take for example Australia or Western Europe, or even some emerging markets, transfers from the government helped offset slower wage growth or outright wage declines in some cases. It could be unemployment insurance, it could be cash transfers to low-income households, it could be other ways of getting money to the pockets of consumers. In China, that hasn't really happened. It's not because the government doesn't want it to happen, it's because for now, the policy framework doesn't really allow it to happen. China's still working on modernizing its fiscal policy to enable it to get money to households quickly when it needs to. But it didn't happen in this crisis. And that means that these households suffered this income shock. They're worried about their jobs. And what do you do when you're worried? You spend a little bit less, you save a little bit more, and of course that leads to slower economic growth. Now, there has been some optimism about the Q2 GDP number, and that, despite what's going on with consumption, has led market interest rates to rise. Things like bond yields, even at the short end of the yield curve, we've seen some interest rates go up. And we've also seen interest rates go up because the central bank in China has suggested that they are more comfortable with the recovery, and they're going to let interest rates rise a little bit from the record low levels that we saw earlier this year. Now, this, we think, is a bit of a problem, and it's going to bear worth watching over the next few months. It's a problem because on this chart, what it does is it tightens financial conditions. Now, by the financial conditions, we mean the availability and price of credit across the economy. And in China, financial conditions are very important for growth. This chart shows one indicator of financial conditions that we build from about 20 different financial variables, including interest rates, including credit. When this line is above zero, financial conditions are loose. They are supporting growth. And when the number is below zero, financial conditions have tightened and they are likely to slow growth. And you can see that after COVID-19, financial conditions eased a lot. Interest rates fell, credit increased, and that was helping support growth during a difficult time. But in the last month or so, financial conditions have tightened, reflecting that rise in interest rates, but also the fact that credit growth has started to slow. Now, typically that would be a good thing in China. China has a lot of debt. We often worry about risks. But at this point in the recovery, we think it is too early for financial conditions to tighten. If they stay tight, if real interest rates stay high, if credit continues to weaken, we would be worried about China's growth going into next year. We don't think financial conditions will tighten too much. We do think that policymakers will try and keep a quite supportive environment for growth. But this is one risk to the growth outlook that we should keep in mind. Okay, let's finish on my third topic, which is US-China relationships and what this means for the outlook, not just this year and next year, but maybe for the longer term. And I'll take an economist perspective. I don't think economists are very well qualified to talk about geopolitics or politics in general. So I will stay away from that and focus much more on the economics of this relationship and how that might play out. And you'll hear a lot of talk about economic decoupling, the fact that US and China are getting further and further apart, and how much of a problem that could be. Well, let's just step back a little bit and look at how close China and the US are currently and how close they've become over recent years. These two charts show how important each country is for that country's trade. So, for example, on the left-hand side here, what we're showing is the proportion of exports to China as a share of total exports for the US. So the dark blue line, for example, here shows that around 15 to 20% of total US imports, all the goods it purchases from the rest of the world, about 15 to 20% are from China. It's a quite large number, for sure. But the US doesn't really rely on China for its exports. So the light blue line here shows that around 5 to 10% of US exports go to China. Most of the exports from the US go to other places, whether it's Western Europe or Latin America or other places. The charts on the right-hand side show the same relationship, but this time for China. So the dark blue line shows the proportion of China's exports that go to the US. And the same is also true for imports. How much of China's imports come from the US? I think the key point about both of these charts is the lines are going down. Certainly for China, if you look at the right-hand side, around 40% of China's exports were going to the US in the late 90s, just as we entered the WTO. That has consistently fallen over the last 2 decades, and now is at the lowest levels we've seen for some time. Less than 20% of China's exports go to the US. We've also seen that relationship get a little bit less, or a little bit more distant for the US also, but that's been a more recent phenomenon and is perhaps related to the trade war and some of the tariffs. But it's certainly true that both imports and exports to and from China as a share of total US trade has started to decline. So in some sense, we could say that the decoupling has already begun. These two charts show something different. They show those same numbers, exports and imports to and from the trade partner, but this time as a share of GDP. And we show this because we want to explain how important is this in a direct sense for the economy. And the answer is not very important. So if you look on the left-hand side, for example, the light blue line here shows the share of exports going to China as a share of GDP in the US. It's less than 1%. So less than 1% of the US economy is dedicated to exports to China. The same is also true if you look at the right-hand side for China. In years gone by, almost 10% of GDP was accounted for by exports to the US. That is now just 3% of the economy. So the bottom line here is that trade with each other is not really a major part of either economy at the moment. So if we did see measures that restricted trade to some extent, it's unlikely to have an immediate or very large impact on overall economic growth in either country. But that's not to say that the US-China relationship is unimportant, but it does say that it's perhaps less about trade and more about other things. And that's something that we've spoken about for quite some time, and we still think it's the right way to view this relationship. But what about phase one, the phase one deal? Hasn't that provided a pathway through which the US and China can resolve their differences? Well, to some extent. This chart shows the basket of US exports to China. And a big part of the phase one deal was China agreeing to increase its purchases of US goods and services over the next 2 years. So what has China committed to buy? Well, a bunch of stuff, but clearly it's going to be focused on areas, first of all, that the US is already exporting to China, and secondly, that the US thinks is politically important. And for now, that means energy and agricultural commodities. So we should expect the share of those two in total US exports to China to increase as a result of the Phase 1 deal. And China probably is okay with increasing its purchases of these commodities, although it does increase its reliance on the US, something that China is probably a little bit careful about at the moment. Buying commodities wouldn't worry Chinese policymakers too much. If there was anything that would interrupt the flow of that bilateral trade in the future, it's very easy to switch to new suppliers. You can easily go to Argentina or Brazil for soybeans, or go to the Middle East or other places for fuel imports. Where it comes down to a much more tricky decision is in terms of technology that is very difficult to switch to alternative suppliers. And this is a hint at where the real meat of the relationship is located. But for now, the Phase 1 deal looks as though it's going to limp on. It's probably not going to be an issue between now and the election. It looks like both sides have strong incentives to keep the deal on track for now. But just look at this chart. Once the election has passed and we go into next year, whoever is in the White House, it's going to be very difficult for China to meet those commitments. The light blue line shows total imports into China from the US since 2012. The dark blue line shows what is required under the Phase 1 deal. This is a massive inflection point. It requires China to hugely scale up its purchases of US goods and services, and we don't think this is very likely. So while the Phase 1 deal may limp on for now, we don't think the long-term prospects of this deal actually being successful are very high. But again, let's step back. It's not really about trade, although that's where a lot of the media attention will focus. There are three fronts in economic terms in this strategic confrontation between the US and China. There is technology, financial, and trade. And of the three, we think trade is the least important. In terms of thinking about risks, financial decoupling is perhaps the biggest short-term risk. If anything were to develop that could threaten the fundamental financial relationship between the US and China, that could pose very difficult challenges for financial markets. We could see fairly large exchange rate moves. We could see a tightening of financial conditions across Asia, including a rise in credit spreads, and that would significantly damage the outlook for growth. So financial decoupling is perhaps the most acute short-term risk that we face. But for now, there's been a lot of rhetoric, but very little policy action on this front. In the longer term, the most important factor is technology. Technology is really at the core of the dispute between the US and China on the three key issues that matter most: intellectual property protection, market access for foreign firms, and a level playing field with China's national champions. And for now, the gap between the two sides remains very wide. How important is this for China? We think it's hugely important for the long-run growth outlook. And let me show you one chart that just gives you an indication of why that might be true. This chart shows labor productivity growth in China since 1990. And what we've done here is we've taken 10-year productivity growth. So it's looking at the long-term trend over time. The yellow line is what's called the secondary sector, which is mainly manufacturing. The brown line here is the tertiary sector, which is mainly services. And what do you take away from this? Well, first of all, the yellow line is almost always higher than the brown line. Productivity growth in the manufacturing sector is almost always faster than in the service sector. And that's true not only in China, but in almost any economy that you care to look at. The second thing I would take away from this chart is look at the far right-hand side. Productivity growth in the manufacturing sector, that yellow line, has been quite flat over the last decade. We're still seeing productivity growth that is, quite frankly, world-beating in China at about 7–8% per year. But productivity growth in China's services sectors have started to decline. They were running at about 8%, and now it's close to 4%. Now, this isn't particularly unusual. As the service sector develops, you're bringing in maybe lower skilled workers, you're doing things that you weren't doing before. It's always hard to keep productivity growth as high as it otherwise would be. This is certainly true of an economy that just gets richer over time. But it's also true that we're not really seeing the reforms in China's service sector to generate the sort of productivity growth that we would need to see to keep overall growth steady. And I think this is the final point that I'd like to make. Over the long run, China's growth cannot be determined by a rising pool of workers. In fact, the demographics for China now are looking worse than they've done for many years. The labor force has already started to shrink. China, of course, has an awful lot of debt. So it's going to be difficult for China to continue investing at the same rate that it has over recent years and simply build more capital to generate growth. The only way, the only source of growth for China over the long run is productivity. And this chart suggests that the manufacturing sector is going to be the driver of that productivity growth over the next 10 to 20 years. And the manufacturing sector in particular is reliant on technology. We looked at the source of manufacturing productivity growth going back to 1980, and it is concentrated in the technology industries, communications equipment, computing equipment, semiconductors. If anything were to slow growth and the ability of China to acquire and deploy technology in its manufacturing sector, that could threaten the productivity outlook over the next 10 to 20 years. So the big uncertainty is, will China's efforts to increase self-reliance, to become more reliant on its own skills, its own technology, over time, will that allow productivity growth to remain around current levels? I think in the long run, we don't know the answer to that question. But in the short run, let's talk about the next 5 years. The more difficult it is for China to acquire and deploy technology within its economy, particularly its manufacturing sector, the slower productivity growth will be, and the slower China's economic growth will be. Now, this isn't a particularly gloomy story. I don't think that growth is necessarily going to collapse in China, even if US-China relationships get worse. And by the way, of course, this will also affect growth not only in China, but also the US and other countries that are part of this technology ecosystem. But it is a very important component of the US-China relationship. Technology drives productivity, and that drives growth. So anything that affects that technology aspect is going to affect the way that we should think about growth over the next 5 years. Okay, let me just finish on our global growth forecasts. I have to apologize, these are a little bit out of date. These were from our last forecasting round in early July. But broadly, I think the story hasn't changed an awful lot. These are some of the forecasts for, first of all, global growth, but also the major economies and Asia Pacific. And I think the most striking aspect of this is, first of all, that Asia Pacific will shrink less than the rest of the world in 2020 and rebound faster in 2021. We still think that's going to be true. In large part, that reflects the fact that Asia Pacific got control of COVID-19 quicker than many other economies. And secondly, that Asia Pacific happens to be doing stuff that the rest of the world wants, particularly the electronic sector. And that has been a source of strength and a pillar of resilience this year, and we think will continue to drive growth next year. But just to go through some of these forecasts very quickly, for China, we still see around 1.2% for growth for this year, although the Q2 number suggests that might be a little bit higher. We'll have to look at that number again in the next few weeks. But we do see a fairly substantial rebound in China, around 7.4% next year. We do expect consumers to start spending again at some point. For the rest of Asia Pacific, we'd expect growth of about minus 1.3% this year before a rebound to 6.9% next year. But that still leaves us well below where we would have been in the absence of the virus. Again, we're recovering, but we're not going back to the new normal, perhaps until 2022 or 2023. So I hope that isn't too gloomy a message. I do think there are green shoots, but we all have to, I think, be realistic about how quickly the global economy and the Asia Pacific economy can come back over the next 1 to 2 quarters. With that, I'll hand it back. For the rest of Asia Pacific, we'd expect growth of about -1.3% this year before a rebound to 6.9% next year. But that still leaves us well below where we would have been in the absence of the virus. Again, we're recovering, but we're not going back to the new normal, perhaps until 2022 or 2023. So I hope that isn't too gloomy a message. I do think there are green shoots, but we all have to, I think, be realistic about how quickly the global economy and the Asia Pacific economy can come back over the next 1 to 2 quarters. With that, I'll hand it back.
Thank you very much, Shaun. So we're now going to take some questions that we've had from the audience. The first question is, as Chinese manufacturing is majorly export driven, is the growth observed in Q2 sustainable?
Actually, the growth in manufacturing, Anna, we think is down to not just exports and the electronic sector. There are 2 other sectors that are very important here that are doing quite well and probably can continue to do quite well for the rest of this year. Those 2 sectors are, first of all, anything related to the infrastructure sector. So we're seeing a lot of stimulus going to infrastructure. And secondly, the property market, which is clearly quite buoyant as well. That's also been a source of strength. And that's affecting manufacturing by lifting demand for things like steel and non-metal mineral products, also non-steel metals. And in fact, those industries are accounting for about 25% of total manufacturing output growth at the moment. So about 1.6 percentage points of the 6% growth we're seeing in manufacturing. So yes, electronics and the export sector are important. We do think that can continue through the rest of this year, but infrastructure, investment, and the property market are also important. So it is a little bit more diversified than just exports.
Thank you very much. So the next question that came in is, how will the increase in China government bond yield relative to US Treasury bond yield affect the 2 economies?
Yeah, that's a good question. I think what the most important near-term effect will be on exchange rates. So when you get back to your desk, have a look at the relationship between the dollar RMB exchange rate and bond yield spreads in both economies. Actually, in the past, it's been fairly close, not always close, but it's usually quite close. And often what you see is when yields go up in China, especially relative to the US, you do see a little bit of upward pressure on the RMB, and that's exactly what we've seen, of course. The dollar RMB exchange rate has come back down again below 7, which means that the RMB is strengthening. This is a bit of a problem, I think, for China. I don't think they particularly want too much currency strength at the moment. I think the PBOC is happy to let the currency move around to some extent, but we are still at a very delicate point in the recovery. And I think they would be very keen not to see too much exchange rate strength at this point. So for us, the big implication is on the exchange rate, and that's going to feed through in terms of certainly that manufacturing and trade story that we were talking about earlier.
Thank you. The next question that we had was, why do China have higher interest rates now? High interest rates mean tightening the flow of money, weakening the demand, and this will reduce the inflation, whereas economy is under recession, and it's good to have inflation to revive the market.
Right, now that's a good question. I think there's a couple of things going on here. First of all, it would be wrong to say that China or the policymakers are trying to push interest rates higher. So if you look at all the key interest rates in China, things like the 7-day repo rate, which is very important for money markets, or the loan prime rate, which is that rate that's set by banks and serves as the benchmark for the real economy, they have been broadly stable. In fact, they've actually come down a little bit so far this year. The interest rates that have gone up to a very large extent are market interest rates, a little bit further along the yield curve, so the 5-year bond and the 10-year bond. And I think those have risen because people are more optimistic about the growth outlook, and you're seeing people sell bonds and buy equities. That's one of the reasons for that backup in market yields that we've seen. But we should also focus on real interest rates. all of the interest rates I've spoken about at the moment are nominal interest rates, the rates that you see on your Cap IQ screen when you open it up in the morning. It's that sort of just the market rate. But for businesses and households in the real economy, it's the real interest rate that matters. So it's that nominal interest rate compared to inflation, or compared to how much wages you're getting paid, or compared to your revenues. And if they are linked in some way to inflation, which we know they are, and inflation is falling in China at the moment, then real interest rates are actually going up. And that's what we've seen over the last 2 to 3 months, a rise in real interest rates. I'm pretty sure policymakers in China are very well aware of this. It'll be interesting to see if inflation continues to fall. We're really talking here about core inflation. Forget about food prices at the moment. But if that core inflation continues falling, it may well be that we start to see some of those nominal interest rates that the PBOC sets start also to come down a little bit, just to prevent those real interest rates from going too much higher. So I think the PBOC wants stability at the moment. It's not trying to move interest rates around too much, but it's this decline in inflation that's causing this rise in real interest rates that's causing a bit of a problem.
Thank you very much, Shaun. So I think we have time for one more quick question. With COVID-19 restricting travel, what do you see on the oil and gas market in Asia Pacific in terms of production of the natural resources?
That's going to be a key question, I think, for next year. I think at the moment, what we're starting to learn very clearly is that countries are not willing to fully open or normalize international travel until a vaccine is here. I think it really just depends on the vaccine. And I think we're starting to get some relatively good news. We've had some news overnight that perhaps isn't so good, but we do have a number of vaccines now in stage 3 trials. It looks as though we're going to get at least maybe 1 or 2 safe and effective vaccines by the end of this year. And then the question becomes distribution. How quickly will those vaccines get distributed? If they emerge by the end of this year, it may well be by the end of Q1 next year, they get distributed quite broadly, especially to the developed markets and some of those big emerging markets that also have manufacturing facilities. That, I think, is going to be key for the travel and tourism sector, and that's going to be driving natural resource demand. So for us, the vaccine and when that comes is going to be the key factor driving some of the, hopefully, the improvements that we see in these industries over the next year or so.
Thank you very much, Shaun.